Good morning. Marc Ostwald from ADM Investor Services International with some thoughts on the strength of the dollar at the current juncture, which seems to be a little bit out of sync with some of the normal metrics that we look at in terms of what drives the dollar above all versus the euro and the yen. So the first chart that we've got today is the US dollar index against the US 10-year German 10-year Bund spread. What's instructive is we've got a game of two halves here. Back in 2018, we saw the dollar under quite a lot of pressure because the yield spread between the two was quite narrow, but gradually, as the yield spread started to widen, so we powered the dollar higher. And that was a fairly good and sound relationship all the way up until about the middle of last year. And then things started to diverge. In no small part because when we really started to diverge was the point at which we thought the Federal Reserve was probably done with any further cuts that it was going to have, whereas the ECB was still expected to cut back in September. But now we've got a really big divergence. We're back in terms of the spread, back where we were back at the start of 2018, and yet the dollar continues to surge. There's no question about it that the weakness of the yen, particularly this year, is playing a key part in that. The interesting aspect of it, if we come to the next chart, is how counterintuitive that is. To start with, the dollar's strength was actually a negative when we started at the beginning of January in terms of commodity prices, and we saw that being driven down. But latterly, during February, we've started to see commodity prices rise. And that is, again, against the normal tune of a strong dollar is bad for commodity prices. But we have got to this point where we are obviously looking at more at supply disruptions in the commodity market and worrying less about the actual dollar strength. There are all sorts of areas where we're looking at disruption, but particularly related to China and the coronavirus. So there's another aspect in play here as well. And so we come to my third table, which is the IMF's forecast for the global economy this year, which in part, I think, is also driving this. What one can clearly see there is the US is supposed to be leading the way. And as much as we've had better PMIs than most people have been expecting today, there is a clear expected underperformance in the UK, France, Eurozone and Germany, and even more emphatically in Japan, which also explains some of that yen weakness. And Japan is no longer the safe haven for the simple reason it looks to be amongst the most vulnerable in terms of the global economy. So how does this pan out as we go forward? If we come to my fourth chart, this is basically telling us about how much disruption there's likely to be, and also plays into this dollar strength game. Because what we've got here is a freight recession because people are expecting Chinese demand to be very weak in the short term, and indeed all the supply chain disruptions as people go into quarantine to be quite, so certainly substantial for some period of time. But what that also means is that global trade growth is going to be negative. And as such, the pool of surplus dollars is going to be that much smaller, and so people will actually have to chase for dollars in terms of dollar funding. Now, my final chart is a completely random thought, and it's really just relates to this. The levels of options trading in the US equity market is now at a level which is scarily high as a percentage of the underlying proportion of share volume trading. And that suggests that there's going to be a lot of gamma and leverage, so that if we do see a big skid under the US equity market, that gamma and leverage will come into play. Those are the thoughts for this week.